I know you've had a really good couple of days here, but people really look to you to kind of make a commentary on what's happening in credit underwriting more broadly. When you're looking at your consumer base, when you're looking at what's happening across the industry, are you seeing things tightening up here?
So I think the reality of American consumer from where we sit is that people are still fully employed. They are shopping. There's definitely lots of rotation. People couldn't travel for 2 years, so now they're very excited to travel. That category grew 122% for us year on year. People are less convinced that they need to work out in the comfort of their own home. So you see connected fitness and sports equipment for home growing a lot slower than it did a year ago. But generally speaking, U.S. consumer is alive and well. In terms of credit quality, I think we are unfortunate to have been dragged down, our stock has been dragged down by some of the folks that are sort of generally bucketed in this category. Frankly, I think completely unfairly, there are people that chase volume and ignore underwriting because they want to grow, and we do the exact opposite. So this silly comparison I came up with yesterday, I think a tremendous amount of financial services, fintechs, in this industry have basically been driving their car with blinders on and foot firmly pushed down onto the gas and hands off the steering wheel. At Affirm, we drive our credit car with very, very much both eyes firmly on the road and hands on the steering wheel doing micro adjustments. From our point of view, and you saw in our numbers, we're doing just fine, and we'll continue to do so because we are, in fact, very committed to steering it carefully.
Well, to the point you're making, you are seeing a lot of fintechs really hit a lot of trouble when they're publicly traded right now in the stock market. Are you saying as we enter this different period of the economy, a much tougher period, that the strategy needs to change? Maybe less marketing spend and more focus on growing responsible customers here?
I certainly should not and cannot speak for the entirety of the competitor set. The two things that are really important to understand about Affirm is, one, our marketing spend does not drive our growth and our consumer acquisition. We grow because we appear on more and more checkouts. We have these fantastic partnerships with Shopify and Walmart and Amazon and literally hundreds of thousands of merchants all over the web. That is where our growth comes. Their shoppers use us to buy things, and that's how we meet these buyers, and that's how we help them. So marketing has very little to do with our growth. Two, credit is a thing you decide to manage long before tough times begin. We have a decade of operational experience and data driving our company to be a fine steward and student of credit. If you wake up in the morning saying, oh my God, we're facing a recession fears a quarter from now or a year from now, you're already toast. You don't have the data or the expertise to do this. The reason we're confident in our ability to drive profitable transactions through growth is because we have been learning for years how to manage credit really, really carefully. And we didn't start out there, but we're quite good at it now.
Max, as we head towards potentially people are worried about whether it's a technical recession and some sort of slowdown, does that mean more people come to your services? Does it mean people pull back because they're spending less on these sorts of Targets and Walmarts and Amazons? What do you make of the landscape for you and how you build your business, the opportunities there?
So we have a very brief but very colorful sample of what happens in a recession. So if you remember, the most recent US recession lasted 3 months, right before the government decided to print money and help folks get through the beginning of COVID. We saw a broad increase in demand for our service. Many of our merchants selling commodity products saw a quadrupling of demand, literally, which is, sounds hard to fathom because people were scared and there were all sorts of things going on. But you still need to feed your family. You still need to buy things, especially consumable things, good or bad economic times. And so folks become much more interested in stretching their dollar. Between inflation and a potential recession, you lose your buying power. The purpose of Affirm is to responsibly give it back to you. And so we absolutely expect increase in demand.
Speaking of volatility and preparing for tough times, we've talked a lot about cryptocurrencies, Max. And I'm wondering, with all the volatility that you see in the market here, if you've changed your mind about any of these products, if it's made you be more cautious about them in any way, and if your clients are asking about them in a different way.
So, look, I think I've always been cautious about cryptocurrencies, largely because it is really easy to get excited about the technology and the math behind things like Bitcoin and Ethereum and all the really cool programmable money that people love to talk about. But if you are a normal Joe Q public consumer, it's easy to get confused. And some of the most recent scandals, frankly, are all about greed, overriding fear and confusing consumers into losing a lot of money, we have just introduced Bitcoin interest into our savings account. So you can actually choose to have your yield paid to you in Bitcoin. It is going to be, for vast majority of our account holders, the balances are not that huge. You will get a few Satoshis here and there. That is a great way for a consumer to feel the rush of being exposed to cryptocurrency. And hopefully, as Bitcoin, overall continues to be one of the best performing assets, actually pick up some interesting yield for yourself. But it's also quite safe. The whole goal here is to make sure that, for us at least, as a company that see ourselves as a steward of our consumers' financial health, we don't want to trip you up. I think crypto products sometimes have the potential, and it's part of our job to warn against those.
Max, I was looking at some finfluencers, for want of a better term, on TikTok and
I've never heard of this.
So there's one great woman called Mrs. Dow Jones, and she's wringing her hands a lot about buy now, pay later at the moment. She's got a lot of Gen Z, young wannabe investors or just users of markets and spending. How you continue to fight the narrative that you are not like everyone else?
If I could have one big brand marketing campaign, it would be all about us not being like everyone else. But I think it's the sort of thing that the more you sort of say, I'm not a crook, the less people believe it. So, we'll just take as many years as it takes to get there. We don't charge late fees. We disclose every single number. The price never changes. All the things that you know about Affirm have always been true from inception, and we continue to do so. Yeah. It's not about fighting the narrative. It's about engaging consumers. Our repeat consumers were 81% of our transactions last quarter, and that fundamentally speaks for itself. People come back because they know we're good for them.